Hello, this is a synopsis of Chapter 9, which is where we discuss how to value, different ways to value a common stock. All right, so in the beginning of the chapter, they talk about some things that affect the value of a stock. The economic environment can affect the value of a stock. And so what they mean by that is how the economy is doing, whether the economy is in a recession or contracting or whether it's expanding. That can certainly, depending on the industry that you're in and your company, that can of course affect the value of the stock. Also, when you think about the economic environment, they're talking about economic growth here, which is what I was just mentioning. Also, unemployment, is the unemployment rate low? Is it high? Of course, that can also affect the overall stock market and individual companies. And then inflation. And so let's just take a minute to talk about the economic environment this summer, summer of 2021. We're coming out of COVID. So really the only headwind that we're seeing is inflation. Inflation is rising prices, as you know. It's too much money chasing too few goods is another way to describe inflation. And so inflation can cause stock prices to go down. It can affect the economy adversely and cause us to kind of cause the economy to contract. Why does this happen? Well, because when inflation is a headwind, what the Federal Reserve will do is they will raise interest rates to try to stave off inflation. And when they raise interest rates, in a nutshell, basically, this is why stocks go down, because when the feds raise interest rates, it makes the cost of capital increase for firms, so they will not expand as rapidly. They may contract, they may lay off people and so forth. So when interest rates rise, it kind of slows the economy down and the reason the feds do increase interest rates is because they want to keep inflation in check. So that's why what's going on this summer is whenever you hear about inflation rearing its ugly head, you'll see the market typically will go down, will sell off because they're worried about increasing interest rates. So that I'm thinking along the lines of your project, your stock projects, that when you're talking about the economic environment, that's really the only negative that's out there right now. So you should think about the large picture when you're thinking about the economic environment for the industry that your stocks are in, and then the companies themselves. So the employment rate, of course, so if you have low employment, the economy is doing well, that's a positive sign. And then, of course, economic growth is a positive sign. So those are, if you're thinking about the macro environment, just think about the big picture and how that affects the market and affects individual firms. And I'll be talking, I will have a synopsis up there in a few days on Moodle that talks specifically about your projects and looking at the big picture in the macro environment. I'll go into more detail there. But anyway, at the beginning of this chapter, they're talking about the macro environment, geopolitical environment, what's going on in the world. Is there unrest or is everything going okay? Is everything going smoothly? And then the regulatory environment, what kind of regulations are we seeing? Of course, companies don't like regulations because it costs money, it increases expenses, affects profits. Okay, so when you're thinking about valuing your company, you think about what kind of impact is the economy having on the firm? What about the industries within the sector? How is that industry being impacted at the moment? And then the specific firms, how are they being impacted? So it's just when you're thinking about valuing a company or trying to value a company, it's just not all about the numbers. You also have to look at the broader aspect. And also another thing to think about is the sentiment. Is the sentiment about the company positive or negative? Because when you think about the market, the stock market in general, it's really just a bunch of people buying and selling. And if there's more buyers than sellers, the price is going to go up, the value will be higher, more sellers than buyers, vice versa. So the sentiment plays a key role too, how enthusiastic people are about the industry or about the particular company. All right, so before I go on with this, let me first talk about basically you have two types of prices out there, or two types of values. You have the extrinsic value, which is the actual price of the stock, what it's actually selling for. So the actual market price of an individual stock, that's the going price, or the stated price, or the extrinsic value, EXTRINSIC, as opposed to the intrinsic value, which is the real value of the company per share. So you have what it's actually selling at, extrinsic value, and then you have the intrinsic value, what the actual value of the company is. So in the long run, these should be in equilibrium. Of course, it should be selling at what it's actually worth. But in the short run, it differs. It's almost never going to be equal in the short run. But in the long run, you should have this long run equilibrium. So why are they not equal in the long run? Why do stocks tend to either be overvalued or undervalued? Well, they might be undervalued if there's been some bad news out there, or the industry's out of favor. And so that could cause the price to go down. People tend to overreact to bad news and overreact to good news. So anyway, so a company could be undervalued because of some bad news that's been out there where people overreacted, or the industry just might be out of favor. A company could be overvalued if it's been very popular, if there's been a lot of talk about the stock or a lot of news about the stock, then the prices run up. Then that would make it overvalued. So you tend to see, so that, of course, the key in investing is to find stocks that are undervalued, buy them, and then eventually they'll go up to their fair value, and you can make some profits. And that's really the goal of what every investor is trying to do, is to find undervalued stocks out there. Okay, so anyway, here's some different formulas that we use. We have some different techniques that we use to try to figure out what the value of a company should be, or what the expected return should be. So when you think about whether a stock is undervalued or overvalued, you can look at it two ways. You can compare the price of the stock to what it's actually selling at. And if the price that you get is higher than what the stock is selling for, then it's said to be undervalued. So you can compare what the expected price should be to the actual price. You can also compare what the expected return should be to your required return. Okay, so this is a formula to calculate the expected return, and this is called the discounted dividend formula. And so all this is, they also call this the constant growth model. So all this is saying is that the expected return on a stock should be the expected dividend divided by the price plus the expected growth rate. So I'm going to show you a specific formula in a little while, but that's what we call this discounted dividend model. So all they're saying is that if a company pays a dividend, the price of the stock or the expected return of the stock is simply a function of the dividends that it pays. Okay, so this is this dividend valuation model. So what they're saying here is that I'm going to go back to that other formula, but let me explain this one first. So this is what we call the constant growth formula. And this is saying that the price of a stock, or the value of the company, this V is the price of a stock. The price of a stock is simply the present value of the dividend stream. So if you have a stock that is growing at a constant rate, if the growth rate is constant, it breaks down to this really simple formula. So the price of the stock is D sub 0, that's the last dividend that was paid, times 1 plus the growth rate, divided by the required rate of return on the stock minus the growth rate. So the required rate of return is given. The required rate of return is using what we call the capital asset pricing model, and that's the return that you should require based on the riskiness of the stock, based on the stock's beta. So we'll get to that in a little while, but anyway, let me repeat this. So this is actually a really simple formula. It's just saying that the price of the stock is the last dividend that was paid, D sub 0, times 1 plus the growth rate, divided by the required return minus the growth rate. Now, this D sub 0 times 1 plus the growth rate, this actually equals D sub 1. So D sub 0 is the last dividend, D sub 1 would be the next dividend that you'd receive. And you just if you want to find out what the dividends are in the future, you just continue to multiply times 1 plus the growth rate. Okay, so just to repeat this, price of the stock today is the last dividend times 1 plus the growth rate divided by the required return minus the growth rate. Now this formula can be rearranged to give us the expected return on a stock. And so basically this is what they're doing here, is they're saying the expected return on the stock is the dividend divided by the price of the stock plus the growth rate. So that's just, they've just rearranged the formula there. Okay, so this, anyway, getting back to this, so if you find, this would give you what the price of the stock should be, then you can go on Yahoo and see what the price actually is. So if the price should be $40 and you go on Yahoo and it's selling for $35, then it's undervalued based on this formula, and this stock would be a buy. If this is $40 and you look at the price and it's $45, that's telling you that it's too expensive, it's overvalued, and you shouldn't purchase it. Okay, so that's the dividend valuation model, or the constant growth model. Now this is how you calculate the required return. So this is another way to see if a stock is undervalued or overvalued. And so you can use this capital asset pricing model. That's how they came up with K, but this is the required return. And all this is saying is that the required return, you should remember this, by the way, from Finance 302. The required return is simply the risk-free rate plus the return that we could get on the market minus the risk-free rate times beta. And so if you recall from Finance 302, the market has a beta of 1. And so it shows the riskiness of a stock relative to the market in general. So if a stock has a beta that's greater than 1, it's riskier than the market. If it's less than 1, it's not as risky as the market. So this will give you the required return based on the beta. And then you can compare this, if your required return is say 12%, to be compensated for your risk, and the expected return on the stock, you can go in Yahoo and calculate what they think the return is going to be, what the expected return is. So let's say that the required return is 12. If the expected return on the stock is 15%, then it's undervalued because you're only requiring a 12% return to be compensated for your risk. If they think the stock is going to return 15%, it's undervalued, you should buy the stock. If your required return is 12, though, and the expected return is, say, only 10%, it's overvalued, you should not purchase that stock. So that's how you compare the required return versus the expected return. And in the video for your project, I'm going to show you how to calculate the expected return in Yahoo. And you can actually do this when you're writing your portfolio summaries. You can compare the expected return to the required return. Okay, and then this is just showing if you graphed the expected return, or excuse me, if you graphed the required return, if you calculated this for each of your stocks, say, you would have, they would kind of cluster around this line. This is called the security market line. And this is just showing that the riskier a stock is, the higher the beta, the higher the required return is going to be. Okay, there's also some other valuation techniques. These are called the multiples approach, and you can one is called the using, you can use the multiples approach using the PE ratio. So, and it's price to earnings. So what you would do here is basically using this PE ratio formula, you can try to calculate the price of a stock. So remember, the PE ratio is the price per share divided by earnings per share. Okay, so if you can go into Yahoo and you can find the forward PE ratio. So let's say that the forward PE ratio is 20 times. So if you have 20, so your PE ratio of 20 would equal P, the price, divided by your earnings per share. And so you can look in Yahoo too and get the earnings per share. So let's say that 20 is the PE ratio, okay? And your earnings per share is 5. So you'd have 20 equals P divided by 5. You can solve for the price then. So you take the 5 times the 20 and it would give you a price of $100. So you see what, with these multiples approach, they're just using these ratios to solve for the price. It's really that simple. And it's just another way to try to figure out what the fair price should be for a company. So what a lot of analysts do is they'll use the multiples models, they'll use the discounted dividend model, they'll use the constant growth model, which is also the discounted dividend model being constant growth. They'll use all sorts of different valuations, and they'll come up with all these different prices, and then they'll usually find an average, or they'll look at a range or find an average, because none of this stuff is exact. So, and you're going to get a different number with each one. But anyway, just to repeat this, using the multiples model, you can take the PE ratio to solve for the price. It's the PE ratio equals price divided by earnings per share, and you solve for the price. You can also use price to cash flows. So you can find the price to cash flow ratio and then solve for price that way, because the price to cash flows equals price per share divided by cash flows per share. You can use the price to book value multiple, price to just about anything. So that's the multiples approach that you'll see in the book. Here's the price to cash flow. You also use price to book value. Okay, now another interesting thing, and this is also something you can look at for your summaries, your portfolio summaries, excuse me, is the PEG ratio. You can look, when you go into Yahoo, they'll give you the PEG ratio on the summary page. I think it's either on the summary page or it's in the stats. So the PEG ratio is really cool. This is used for growth stocks, and this standardizes the PE ratio for growth. So the PEG ratio is simply the PE ratio divided by the earnings growth rate. All right, so think about that. And the lower the number, the better, okay? So if a company has a low PE ratio, but a really high earnings growth rate, they're said to be undervalued. And so when you look at these PEG ratios, these low PEG ratios suggest that they're undervalued. So a PEG ratio of below 1 suggests that a stock is undervalued. And so it possibly a good buy. I think 1 to 2 is fairly valued. 1 from 2, 2.5, and then anything really over 3 is overvalued. So I'd say 1 to 3 is fairly valued, and then over 3 would be is overvalued. So, but ideally you want to find a PEG ratio in a growth stock that's less than 1 that suggests that the company's undervalued. So anyway, you can take a look at those PEG ratios. They're already calculated in Yahoo for your stocks, and that you can use that in your analysis if you like. All right, you don't have to worry about the adjusted PEG ratio. Now, efficient market hypothesis. Make sure you read about that in the book and take a look at that before you take the exam, take the quiz. Basically, what the efficient market hypothesis is saying is that historical information and publicly available information is already factored into the price. And so it's saying that the markets are efficient, that we can't make abnormal profits in the stock market, that most of this information is all priced into the stock, and that the markets are efficient. If the markets weren't efficient, I mean, if people didn't believe in the markets and they believe in the efficiency, then people wouldn't invest, and the market they'd sell their stocks, and the market would really crash. So it's really important that people have faith in the market and believe that the markets are efficient. Now, some people, I mean, in reality, don't think it's a level playing field, as you know, as referenced by what's happening with Reddit and what happened with GameStop last in the spring of 2021. But overall, people believe that the markets are efficient. And so anyway, just make sure you read that in the chapter before taking the quiz. There's a question or two on that. Okay, now in addition to these formulas, there's also a non-constant growth formula. So let me go back to this constant growth model here that we write here, this dividend valuation model. Okay, if dividends grow at a constant rate, you can use this formula, like I said, okay? But if sometimes you have a situation where the dividends, where the growth rate is super normal. You have a high growth rate early on. Let's say a company is a brand new company, and they're in this super normal growth phase. So they have a high growth rate of about 20 or 30% for the first 2 to 3 years. Then they go down to this constant growth rate. Well, when that happens, there's a few more steps. You can't use this constant growth formula until the growth rate goes constant. Prior to that, you have to calculate the dividends by hand, and then you have to bring all of the dividends and this constant growth, this price that you get when it goes constant. You have to bring that back to today's dollars, to today. So what I'm saying is, if you have a situation where it's called a supernormal growth situation, where the growth rate is non-constant, you have this high growth rate for like the first 2 or 3 years, you have to calculate those dividends until it goes constant. Then when the growth rate goes constant, you can calculate the price of the stock. So let's say it goes constant in year 3. You use this formula in year 3 to calculate the price of the stock, but then you've got to bring it all back to the present value to get the price of the stock today. So I have some sample problems in Moodle for you to look at, and the answers are there too to help you before you take the quiz and also before the exam. So let me try to share those sample problems with you. And feel free to give me a call or text me if you have any trouble with these, because they can be a little bit confusing. All right, so try to work these on your own, and then just and work the homework. That you have the solutions there for the homework too, and then let me know if you have any problems. Okay, so here's the key. This is in on Moodle, but try to work the problems on your own and solve it before you look at the key. But let's just go over these examples, and then you can go back in without the answers and try to solve it on your own. So this is just simply saying, asking you about dividends. So a company just paid a dividend of $3 per share. meaning that's the past dividend. So D sub 0 is $3. The dividend is expected to grow at a constant rate of 4%. What is the dividend at the end of year 3? Okay, well, all you have to do there is take D sub 0 times 1 plus the growth rate to the nth power. So you're going to take $3 times 1 plus 0.04. So it's going to be $3 times 1.04 to the third power. That's going to give us the dividend at the end of year 3. Okay, so try to work that one on your own. Okay, and then this is the constant growth formula. So this company just paid a dividend of $3. The growth rate is 5%. Investors require an 11% rate of return. What's the price of the stock? Okay, so this is just going to simply be P sub 0 is going to be D sub 0 times 1 plus the growth rate divided by the required rate of return minus the growth rate. So it's going to be $3 times 1.05 divided by 0.11 minus 0.05. You have to use the decimals here, and you should get 5250. I mean, if you're a few cents off, it's not a big deal. It depends on how far out you go with your rounding, or how many places you go. Okay, this is the same. This is just like this one. This is a constant growth model. Okay, now the 4 and 5 are non-constant growth models. Okay, so let me try to explain this to you in words, and then if you have trouble figuring it out, give me a call or text me, email me, and I'll help you. Or we can do a Zoom call. Okay, so the last dividend that was paid by Klein was $2.20. The Klein's growth rate is going to grow at 10% for 2 years. Then the dividends are going to grow at a constant rate of 6%. Okay, so we can't use this constant growth formula until we get to year 2. All right, so what we have to do, so there's 3 steps to this problem. Step 1 is to calculate these dividends until it goes constant. So the first thing you should do is calculate D sub 1. So you're going to take 220 times 1.1. That's going to be D sub 1. Then you're going to calculate D sub 2. That's going to be 220. That's going to be whatever you get. Well, that's going to be 220 times 1.1 squared. That's D sub 2. Okay. Then you're going to calculate D sub 3. That's going to be 220 times 1.1 squared times 1.06. That'll give you D sub 3. Okay, so we've got D sub 1, D sub 2, and D sub 3. So you calculate the dividends until the growth rate goes constant. That's what we just did. Step 2 is to calculate the price of the stock once it goes constant. So now we're going to use that constant growth formula and calculate the price of the stock. So we're going to take, so the price, it's the price in year 2 when it goes constant. So the price in year 2 is going to equal D sub 3, that third dividend that we calculated, D sub 3, divided by the required rate of return minus the constant growth rate. So it's going to be D sub 3 divided by 11% minus 6%. Okay, so we have D sub 1, we have D sub 2, and then we have the price of the stock in year 2. We've got 3 things there: D sub 1, D sub 2, and the price of the stock in year 2. Now, those 3 things, we have to find the present value of those, add those up, and that's the price of our stock. Okay, so now what we're going to do is we're going to take D sub 1 and we're going to find the present value of it. So we're going to take D sub 1 and we're going to divide that by the required rate of return. So it's going to be D sub 1 divided by 1.1. That's going to give us our first number over here. Then we're going to take D sub 2 and we're going to divide that by 1.1 squared, finding the present value of D sub 2. Then we're going to take the price of the stock that we found when it went constant. We're going to divide that by 1.11 squared and add those three things up, and that'll give us the $50.11. So that's how you calculate the price of a stock when you have this non-constant growth situation. Okay, and then this is the same thing. In this situation, this company, it's growing at 5% for 2 years, and then it's going to grow at 10% forever. So you're going to find D sub 1, which is $1 times 1.05. You're going to find D sub 2, which is $1 times 1.05 squared. Okay. Then you're going to find D sub 3, $1 times 1.05 squared times 1.1. Okay. Then you're going to find the price at the end of year 2 when it went constant, and that's going to be D sub 3 divided by 12.12 minus 0.10. So it's D sub 3 divided by 0.12 minus 0.1. That gives us the price of the stock. So we have D sub 1. So then the final step is to find the present value of D sub 1, D sub 2, and the price in year 2. So we're going to take D sub 1 divided by 1.12, D sub 2 divided by 1.12 squared, and then the price in year 2 divided by 1.12 squared. Add those three up, and you should have $50.04. So anyway, that's it. So take a look at, after you look at the synopsis and read the book, read this chapter and work these problems, just let me know if you have any questions. And then as now you're, once you take the second test, that's when I suggest you really start in earnest working on your stock valuation portfolio summaries. And so I will have by the time you, well, in the next couple of days, or definitely once you've finished taking exam 2, I would look at the summary that I've posted that gives you some hints on how to, on what information to include in your stock summaries. Okay, until next time, goodbye.